Welcome back, traders. I'm glad to have you here today. We have covered all the reliable and most powerful Japanese candlestick patterns in this course. It's time we delve more into how to trade the long-term pattern. We learned that long-term patterns can be used in two ways, which are: Number 1, for the continuation of a trend. Number 2, for the reversal of a bullish or bearish trend. And I showed you a few examples in one of the previous sections in this trading course. Therefore, it's time I introduce you to the list of the most powerful, effective, and most common long-term patterns in the market. Here is the list of this long-term pattern. The Head and Shoulders long-term pattern. This pattern can exist as a simple, broadening, or complex formation. We will focus on the simple pattern for now. The channel. The wedges. The rectangle. The flags. The pennant. The double tops and double bottom. The round tops and bottom. The triangle variations. The triangle long-term patterns have the highest variations of formation. These are the symmetrical triangle. The reverse symmetrical triangle. Some traders referred to it as the megaphone pattern. The left angle triangle. The left angle triangle is different from the reversal symmetrical triangle. The right angle triangle. This can also be called the descending triangle. The ascending triangle. There are more long-term patterns, but these listed patterns are the most powerful, reliable, and easy to identify long-term patterns, especially for beginners in the market. You don't have to trade all patterns that appear on the trading chart. Remember, trading is a game of probability. Therefore, it's better to master long-term patterns that are not too complex to detect and analyze. Once you get yourself familiar with these simple long-term patterns, then you can advance your knowledge to the complex ones, such as the multiple tops, the broadening patterns, and others. I have introduced the Head and Shoulders long-term pattern to you in the early stage of this trading course. The bearish formation of this pattern is called the upright head and shoulders, while the bullish pattern is called the inverted head and shoulders. We have discussed the simple pattern of the head and shoulders. Do you know that the simple pattern of the head and shoulders can also exist in different variations? Yes, the simple pattern of the head and shoulders can exist as follows. Number 1. As a straight neckline head and shoulders pattern. This could be a straight neckline for the upright or the inverted head and shoulders. As we can see on this chart, the pattern on the left-hand side, tagged A, is the upright straight neckline of the head and shoulders long-term pattern that supports bearish anticipation, while the pattern on the right-hand side, tagged B, is the inverted straight neckline of the head and shoulders long-term pattern that supports bullish anticipation. Number 2. It can also occur as an ascending or descending neckline for the upright or the inverted head and shoulders long-term pattern. Here's the ascending upright head and shoulders formation. As we can see, the neckline has a trend line pointing upward. Due to my years of trading experience, the upright ascending neckline of the head and shoulder offers a more profitable sell entry opportunity. Take note, although the upright head and shoulders pattern supports a bearish implication, but some offer a better entry opportunity than others. This is a topic I will give more explanation about under volume analysis in relation to long-term patterns. This is the upright descending neckline of the head and shoulders. The descending neckline offers little profitable entry opportunity when compared to the upright straight and ascending neckline. Most time they may lead to a bearish trap move. Here comes the descending inverted head and shoulders. As we can see, the neckline has a trend line pointing downward. The descending inverted head and shoulders offer a more profitable buy entry opportunity more than the ascending inverted head and shoulders long-term pattern. This is the ascending inverted head and shoulders. As we can see, it's usually not as effective and powerful as the inverted straight or descending neckline head and shoulders pattern. How can we forecast the potential profit objective of the head and shoulders long-term pattern? The profit objective of the head and shoulders can be forecasted by taking the measure of the price breakout point to the peak of the upright head or the trough of the inverted head. Next is to extend the pips value in the direction of the technical implication of the head and shoulders. This profit move objective becomes reliable if the measurement forecast value aligns to a key level or swing point on the trading chart. The rule is to take profit whenever price movement achieves this measurement price value. How can we manage our risks when trading the head and shoulders long-term pattern? Managing risk when trading the head and shoulder long-term patterns depends on traders' trading methodology. Irrespective of traders' trading methodology, they must first ensure a strong volume breakout occurs out of the neckline of the pattern. As a short-term trader, it's better to wait for the retest of the broken neckline. The next step is to make sure there's a sharp rejection through a reliable bearish price action candlestick. Examples of this bearish price action short-term patterns for an upright head and shoulders confirmation entry are the bearish engulfing candlestick, the bearish pin bar, the evening stars, the dark cloud, bearish Marubozu candlestick. While for an inverted head and shoulders, bullish price action confirmation entry candlesticks are the bullish engulfing candlestick, the bullish pin bar, the morning stars, the piercing, bullish Marubozu candlestick. Short-term traders can then proceed to hide their stop loss at the swings of invalidation of this entry confirmation price action candlestick. Long-term traders need to focus more of their attention on the volume breakout of the pattern neckline. As a bonus offer, they can wait for a retest of the broken neckline, but in a fast-moving breakout, a retest may not occur. Long-term traders can place their stop loss at the peak of the upright shoulder or trough of the right inverted shoulders.